So, you finally saved your first $1,000. Congratulations, you are now officially dangerous. Today, we learn how to invest it without feeding it to nonsense. Just the beginner map before the market smells fear. Before buying, pause. Excitement is where mistakes breed. Do not let one afternoon control your money. Your first job is not to invest fast. Your first job is to invest correctly. Boring preparation beats expensive confidence. First, make sure this money is free. Money needed soon stays out of the market. Emergency savings prevent forced selling. Stocks do not care about bills. Invest only money you can leave alone. Markets punish desperate hands. Next, look for high-interest debt. Some debt quietly eats your future. Paying that down may be smarter. Not every dollar belongs in stocks immediately. Sometimes defense comes first. Even rich people respect math when it bites. Now decide the purpose. Short-term money needs safety. Medium-term money needs balance. Long-term money can usually handle more market movement. Your time horizon chooses the tool. Random goals create random portfolios. To invest, you need an account. A broker account lets you buy investments, connecting your money to the market. You need identity details and a bank. After opening, tools appear. The hard part is behaving after access is granted. Now comes the dangerous part.
Random choices feel exciting.
But excitement is not research. Your first 1,000 should teach structure, not impulse. A beginner needs a system before opinions. For education, imagine one simple structure, not a command. Many beginners keep it simple. A broad fund can spread money across many businesses, and some cash prevents panic. Simple beats clever when clever is pretending. Broad market funds are often beginner-friendly. They hold many companies, so your result does not depend on one business. One problem hurts less. You accept market risk, but you are not betting everything on one horse with a logo. Costs matter more than beginners think. High fees quietly reduce returns. The difference can grow over time. Always check the expense ratio. Small percentages can still matter. Never let invisible fees eat loudly in silence. Now know your risk tolerance. Everyone loves risk when prices rise, but declines feel different. Choose a level you can survive. Do not copy someone else's stomach. The best plan is useless if fear makes you quit. You can invest all at once or slowly. Lump sum starts working immediately. Slow entry feels easier. Neither removes uncertainty. The choice depends on discipline. A perfect plan you abandon is worse than a simple one you keep. Investing slowly is called dollar-cost averaging. For example, 4 smaller buys. You buy through different prices. It can reduce emotional pressure because the schedule decides first. Automation is discipline wearing a clock. Some investments cost more than your cash. Fractional shares solve that. You can buy part of a share. Many platforms allow small amounts. Beginners can start without waiting. Ownership can begin smaller than your ego expects. Before buying, understand order types. A market order buys fast at the available price. A limit order sets your price. Prices move. Never click what you do not understand. In finance, buttons are doors with consequences. Before buying, ask 4 simple questions. What am I really buying? Why does it fit my goal and timeline? What does it truly cost, including fees? What could go wrong? Answer first, purchase second, so excitement does not decide. Now imagine the choice is made. You enter the amount carefully. You review the details one final time. Then you place the order. Cash becomes ownership in a real company. Very good. You have purchased responsibility. After buying, nothing magical happens. No parade. Real businesses continue operating. Your value will move. Your job is patience. Investing is less dramatic after the click, which is exactly the point. Some funds may pay dividends. You could take the cash or reinvest them. Reinvesting buys more ownership. That helps compounding. Tiny payments become useful when they stop escaping. Now meet the guest, taxes.
Investments can create tax events. Rules depend on account type and location. Accounts are treated differently.
Do not panic, track. Ignoring taxes does not make them disappear, it makes them dramatic. Do not stare daily. Small moves feel huge when zoomed in. Zoom out. Checking constantly feeds emotions. Use scheduled reviews instead. A watched portfolio boils your brain, not your wealth. Over time, your mix may drift. Winners can become too large. More growth can also mean more risk. Rebalancing restores your plan, not every day. Balance is boring until imbalance becomes expensive. Then comes the temptation, individual stocks.
One company can feel more exciting.
But one company can also disappoint.
Single names move harder.
Use caution. Curiosity is fine. Concentration is where beginners get bit. Some tools are not beginner toys. Options and leverage can magnify outcomes. Magnify gains, yes, but also magnify mistakes. Learn slowly. The market already has enough ways to humble you. Some assets rise from hype. Crypto and trends move wildly. Volatility is brutal. Do not confuse excitement with necessity. Never risk money you cannot lose. If you do not understand the monster, do not feed it. Your first 1,000 is not the finish line. The real power is consistency. Even small regular amounts can build habits. Automation reduces decision fatigue and excuses. Wealth loves routines more than speeches. Eventually, the market will fall. This is normal, not automatically disaster. Return to your plan. Long-term investors expect rough periods. Do not make fear your advisor. Panic is expensive because it feels urgent. Selling should have a reason. Maybe your goal changed. Maybe the investment changed. Maybe your plan needs adjustment. Fear alone is weak evidence. Sell because of logic, not because your stomach sent an email. Write down exactly what you did. Record the reason behind it. Future you forgets context fast. Notes protect you from emotional rewriting. Keep it simple and honest. A written plan becomes a strong leash for future panic. Once invested, keep learning. Learn what different assets do. Understand ownership, income, and stability. Knowledge grows slower than hype. Avoid miracle promises. Education compounds too if you stop chasing magic. Set realistic expectations. Your first 1,000 will not make you rich tomorrow, but it can start the habit, and that matters more than the amount. The first 1,000 is a foundation. Not glorious, but yachts hate weak foundations. A common mistake is collecting chaos. More investments do not mean better diversification. Sometimes they mean confusion. Simple is stronger. Know each piece's purpose. A messy portfolio is clutter in a suit. After investing, review later. Not every hour. Ask whether your plan still makes sense. Check goals, risk, and consistency. Ignore useless noise. Reviewing is maintenance. Obsessing is entertainment for anxiety. So the simple map looks like this. Protect money you need soon. Respect expensive debt. Choose the account and purpose. Invest simply and diversify. Then automate, review calmly, and stop worshiping daily charts. Success is not doubling money immediately. That teaches arrogance. Success is building a repeatable system, saving, investing, learning, and staying consistent. $1,000 invested should create behavior, not delusion. Before we finish, remember the traps. Do not chase noise. Do not sell from fear. Watch costs. Avoid tools you do not understand. Your first 1,000 deserves protection from your worst impulses. Here is the final checklist. Only invest money you can leave alone. Know the purpose. Keep costs low and diversify. Write the plan before emotions arrive. Then invest, automate, review, and let time do the heavy lifting. Your first 1,000 won't make you rich overnight, but can make you serious. Protect, choose, diversify, wait. Beginners become investors calmly, suspiciously. The market loves patience. Impatient people fund my lifestyle.